Welcome to Talk Tickers, where we break down the latest earnings calls. Today, we are digging into Vistra Corp's third quarter results for 2025. And folks, this one's a head scratcher. We've got a huge beat on profit, but it's kind of overshadowed by a pretty surprising revenue miss. So let's unpack what's really going on with the stock.
All right, so here's how we're going to tackle this. First, we'll hit the big headline numbers from Q3. Then, we're going to get our hands dirty and dig into what's really driving those numbers under the hood. After that, we'll take a close look at management's strategy, what they're calling scale and secure, and what they're telling us to expect going forward. And of course, we'll wrap it all up with our official rating and a fun little trade idea for the next quarter. So Vistra's third quarter, wow, it really was a tale of two totally different metrics. You look at one number and you think, amazing. You look at another and you're left scratching your head. We've got this huge split between the company's profitability on one side and its revenue on the other.
And here it is, the central puzzle of the quarter, laid out plain and simple. On one side, you have profitability just crushing it. Adjusted earnings per share beat expectations by a staggering 46%. But on the other side, a major miss on revenue. We're talking down 21% from last year and over $1 billion short of what analysts were expecting. This is that split we really need to get to the bottom of.
I mean, look at that earnings power. It's just undeniable. They came in at $1.75 per share when the consensus was only looking for $1.20. So you got to ask, right, why did the stock actually close down 2.5% on the day? Well, it seems pretty clear the market was zeroed in on that top-line miss. It looks like investors were signaling, hey, we're a little worried about revenue stability, maybe more than these short-term profits. Okay, so how in the world does a company beat so big on profit while missing so badly on revenue? It sounds contradictory, right? Well, the answer starts to become clear when you look at the operational breakdown. You have to see where Vistra is actually making its money. And boom, here's the key. Take a look at the generation segment. It was an absolute powerhouse, pulling in over $1.5 billion in adjusted EBITDA. Now, how'd they do that? It was all thanks to a really smart hedging strategy that let them lock in higher prices. I mean, this was so effective that it more than covered for some other headwinds they had, like an outage at their Martin Lake unit. Now, compare that to the retail segment. It was practically a rounding error at just $37 million. That's where the story is. You know, this quarter wasn't just about the numbers we just saw. It was really about the strategy behind them. Management is rolling out a very clear multi-year plan that they're calling Scale and Secure. And the whole idea here is to take all the wild swings and volatility in the power markets and turn that into a predictable, reliable stream of cash flow for the long haul. And this really breaks down their four-part playbook. First up, acquire. They're buying up capacity, like that recent deal for 7 natural gas plants. Step 2, build. They're not just buying, they're building new stuff where it's needed most, like those new gas units in West Texas, where demand is just exploding. Third, and this is crucial, contract. They're locking in customers for the long term. A perfect example is that massive 20-year deal they just signed at their Comanche Peak nuclear plant. And finally, step 4, hedge. They're aggressively locking in future prices to give everyone some certainty. And you can really see just how serious they are about that hedging piece. I mean, look at this. They have basically all of their expected generation for 2025 and 2026 already locked in. For an investor, what that means is you get tremendous visibility. It gives you a really high degree of confidence about what their cash flow is going to look like in the near future. Less guessing, more knowing. All right, so let's look forward. When it came to guidance, management didn't just play it safe. They came out with a really strong outlook. And to me, that signals they are super confident, not just in their own scale and secure strategy, but also in the tailwinds they're seeing from this incredible surge in power demand. So let's actually look at the guidance they provided. For 2025, they actually tightened up their range and raised the low end, which is always a good sign. But then they gave us our first peek at 2026, and wow, it's a really robust outlook. What you're seeing here is a pretty significant step up coming in both adjusted EBITDA and free cash flow. That's a clear signal that the business has some serious momentum. And here's something really important. Management made a point to highlight a new metric they want investors to really pay attention to: adjusted free cash flow per share. And get this, they are projecting around 50% growth in this key metric between 2024 and 2026. Why does this matter so much? Because it's a 1-2 punch. It captures not just the growth in the business, but also the impact of them buying back their own stock, which makes each remaining share more valuable. So you might be wondering, what's fueling all this confidence? Well, it's intense customer interest. The leadership team said it straight up on the call.
The number of inbound requests they're getting, especially from data centers powering the whole AI boom, is the highest it has ever been, period. That's the foundation for their belief that they can keep signing more of these really valuable long-term contracts.
Okay, so let's put all the pieces of this puzzle together. You've got the big earnings beat, the surprising revenue miss, the super strong guidance, and this whole macro story with AI demand. It's time to synthesize all of that and land on our investment thesis and our official rating for Vistra.
So really, where does Vistra stock go from here? For any investor looking at this company right now, it all boils down to one central question. Does that powerful long-term growth story, the one being driven by AI and data centers, does that outweigh the short-term choppiness and the very real risk that comes with building all these new projects?
So let's break down the bull versus the bear case. The bull case is pretty straightforward, right? You've got these huge tailwinds from AI and data center demand. You've got that really strong 2026 guidance and a management team that's serious about returning cash to shareholders through buybacks. But the bear case is all about the risks. They'll point to that volatile revenue, the execution risk on these big new construction projects, and the ever-present potential for things to go wrong, like an unplanned outage.
All right, so after weighing everything, we're initiating our coverage with a market perform rating. Look, we think the AI-driven growth story is absolutely compelling. There's no doubt about it. But we also believe that a lot of that good news is already reflected in the stock's current price. So for us, the key thing to watch from here on out is simple: execution. They've got to deliver on these new projects.
Okay, and now for our outrageous but plausible trade idea. Think about a pair trade here. You go long Vistra, betting on their assets, nuclear and natural gas, that can provide power 24/7, exactly what these massive data centers need. Then you pair that against a short position in a pure play renewable utility, say a solar or wind company. Why? Because their power is intermittent. It's not always on, and they might have a harder time meeting the insane reliability demands of the hyperscalers. It's a bet on reliability.
And before we wrap things up, we have to share one final and very important point.
Please remember, this analysis is for informational purposes only. It is not financial advice.